I think that people that say we're out of the bear market are slightly jaded by hopes and dreams. I look at the charts. As long as we haven't taken out 30,500 and stayed above it, I'm in the camp that this is still going to come back down.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin and Ethereum. He believes that we could possibly see Bitcoin's low in the coming months. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed.
Let's talk a little bit about the debt ceiling. Last weekend, that was a holiday weekend here in the United States. We know that Monday the markets were closed at least for stocks and commodities. There were some futures trading. Futures did trade accordingly till 1 p.m. Eastern time. But basically the bottom line was that we had a day where the markets were closed but reacting to the debt ceiling news. And again, just for anyone who's been out of the loop, McCarthy and Biden came out and they basically said we have a decision on or an agreement on the debt ceiling. It still has to be voted on by Congress, by the Senate, by the House, but ultimately it's expected to pass. Now, if you looked at the markets yesterday, we opened higher and then we kind of sold off. Tech was strong. Why? Because of the AI insanity. And talk about insanity, folks. And I want you to use this to start to shape your minds to avoid the hype. All right, now what I mean by that is that if you look back at past periods where there was insanity in the markets and you were seeing stocks going up 50, 100, 200, 300%, if you bought towards the higher end after they had already rallied, 9 out of 10, maybe 99 out of 100 people ended up losing money. So in this AI craze, if you look at something like Nvidia, it's up from $100 to over $400. Think about that. Yes, AI is sexy. It's important. It's going to be game-changing. But you know what else was game-changing? The dot-com revolution, the internet. And if you go back to 1999, think about what happened there. All these stocks ran up hundreds of percentage points, and then I would say at least half of them went out of business. In addition, a bunch of them got acquired for pennies on the dollar, and then some survived, but their prices got cut by 90% before they moved higher. Example, Amazon. Amazon was a great example of this, where you ultimately had it dropping 90+% from its highs in the dot-com era down to like $6, and then it proceeded to go much, much higher, gaining thousands of percentage points. So my point is this, is that the hype out there is real, but it is not something you want to get caught up in. Sit on the sidelines, let this stuff flush out, it will come in. In fact, I'm going to show you a chart on Nvidia right now. We're going to go to my charts here, and I want to show you this chart. Let me bring up Nvidia here, folks. Bear with me as I do that. Okay? And Nvidia's chart told us that basically as of yesterday, there is a defined pivot top. Okay, now when I show you this chart, you can see this candle formation. This candle formation is known as a topping tail. And a topping tail tells you that it was so extended that so many buyers, the remaining buyers got involved, but big money sold into it. All right, when big money starts to unload, what happens? Well, it was trading at the highs of this tail, and big money pushed it down. Their volume, their money was more powerful than the small investors, the last few investors that were getting long. And that's really what markets are, right? It's greed and fear. And then you have institutions that think logically. You have traders like me that think logically. And ultimately, that topping tail is a signal that Nvidia has topped until proven otherwise. All right, so what I would do in this situation is you should look for further downside. In fact, pre-market, it is trading down just a little bit. There'll be some support around 389, which will be gap fill. But I'll tell you this, the gap that it created from a move up from 305 up to this 420.25 level, that will eventually get filled. Is that gaps are made to be filled. You don't know when, but at some point that gap will be filled. And my guess is, as the markets turn away from the debt ceiling, as we start to focus on the fact that the Fed funds futures are now pointing to a 66% chance of another rate hike starting in June, which is next in 2 weeks. 2 weeks from today, we're going to hear from the Fed. And now the markets are pricing in a likely hike of 25 basis points. So think about that, right? So again, you have the hype of the debt ceiling where small investors are like, oh, this is great, we're not going to default. I would counter that we never were going to default. Tell me which side of the aisle was going to be okay being blamed for a default of the U.S. They weren't going to do it. All right, it just wasn't in the cards because neither one is stupid. Now, we may not agree with this side or either side of the political, basically framework, but the bottom again is that you have to look at their motivations. They want to get reelected. Well, you know what? You let the U.S. default. How many people are going to be like, yeah, let's vote for that guy again? He screwed us all, right? I mean, think about that logically. So that's done with. Small investors got lured into the market. Now you have the fact that you turn your attention back to, wait a minute, the Fed is going to hike again, 25 basis points, all the way up even more? How long are we going to remain? I mean, we're almost half the way through the year. At one point, people were saying there was going to be cuts in the second half. We're still raising rates now that we're halfway through the year. All right? Inflation is remaining stubbornly high, which if you go back 6-12 months ago, I told you this. I gave you this game plan. The Fed was saying transitory a couple years ago. I said, nope, won't be transitory. And I said, inflation will come down from 9% because it's easy. You fix the supply curve, you fix the supply chain, you bring it down. What's going to be harder to fix is the fact that the retail worker, the average worker, is now making, instead of $12 an hour, they're making $20 or $25 an hour. That has to be passed through to the consumer. Now, an individual business can't pass that through overnight, right? I mean, imagine you go and you want to buy a lollipop, and instead of it being $1, it's $5. That's not going to happen. So what are they going to do? They're going to raise it from $1 to $1.05, and then the next year $1.10, and then the next year $1.20, and so forth and so on. So that's the way it's going to play out, which is going to keep inflation stubbornly high for at least the next year. That means the Fed is not cutting rates. The economy is already showing signs of stress. All right. By the way, I've heard this from businesses now. Businesses are now focusing on their employees and saying, okay, what have you done for me lately? And some of you guys may be watching and saying, you know what, this is exactly what's happening at my company, where all of a sudden the numbers, it didn't matter before. When everything was great, no one checked up on you. Everyone was like, hey, listen, the company's making more money than it's ever made. No need to check up on you. But now things are starting to get tight. They're starting to say, okay, who's the top producers? Who are the people not producing? We need to start to look at this. And that is what's happening now. It's the beginning stages of a recession. Check this out, guys. You know, and this is where you get the smile on my face when you get multiple factors. Let's do a Fibonacci retrace. Many of you guys know Fib. I'm a big fan of the Fibs because anything that occurs naturally in nature, if you look again, and I've said this before, but the petals on a flower, Fibonacci sequence. The rings on a tree, Fibonacci sequence. If it occurs in nature, there's some impact on us. We are part of a bigger world. It is generally going to be important. So let's just see. What happens if we take the all-time high to the October lows? Where is that Fib retrace? Well, would you look at that? A 618 to the penny, essentially, is where we're currently trading on the NASDAQ. Now, listen. Does it mean that the fact that we have 4 factors here, does it mean that we can't go higher? No, we could, right? Factors, and this is what I want everyone to understand. The factors of a chart are probabilities. The more factors, the higher probability. All right, now, you can get probabilities to 99%, and there's still a 1% chance it doesn't work out. In the case of 4 factors like this, I would say there's about an 85% chance that the NASDAQ will start to correct and pull back. Now, the question is it going to be a big pullback, a little pullback? What is it going to be? I would say there's a decent chance that this is the high of the bounce cycle, okay? Now, I'm going to show you why, and this is going to be even more mind-blowing. We're zooming back to the 2000s. Remember the dot-com bubble, all right? Look at this. Here was your high of the dot-com bubble. Occurred in 2000. That's somewhat irrelevant to what I'm saying. The first fall, we dropped about 40% on the NASDAQ 100. We then bounced 40% or 41%. All right, so you dropped 40%, you bounced 40%. Okay, so that's kind of interesting. All right, so we fell 40, we bounced 40, and then the dot-com collapse continued. We had this epic drop. Now let's go to the 2007 high. Remember the Great Recession. Here's the NASDAQ 100. It topped out in 07. Okay, again, somewhat irrelevant. We fell 25%. We bounced about 24-ish, almost 25%. Are you guys starting to see a theme here? So what we're seeing is that when you have a major top on a cycle, it tends to make a high, fall X%. So let's say you have a different cycle. It would start out here. It would drop, let's say, 20%, and then it bounces 20 before the next big rollover. And we've seen that now in 1999 to 2000 and 2001, and now again in 2007. The reason why these cycles work and they generally, if not repeat, they rhyme, is because do you know who's trading all of this stuff? People. Emotion. Greed and fear. So the greed and fear, the greed that was in the dot-com bubble in 99 was the same greed emotion that was in 2007 and the same greed emotion in 2021. So if you understand that, again, charts are replications of humans trading via emotion, it starts to make sense why history tends to rhyme, if not repeat. All right, next up, we're going to go back to Bitcoin. I just want to give you guys your update on Bitcoin here. Bitcoin, again, you guys know I've been steadfast. I think personally 30,500 is the short-term top. I still am not convinced we're out of the bear market yet. I think that people that say we're out of the bear market are slightly jaded by hopes and dreams. I look at the charts. As long as we haven't taken out 30,500 and stayed above it, I'm in the camp that this is still going to come back down. All right, we did fall back there. We fell below it. Okay, now notice how as we broke down over the weekend, number one, volume was light. Number two, it was a risk-on period because of the AI bubble and the AI craze. We went right back to that trend line on the charts, and then we pulled back here. Now again, what I'm watching for is do we take out 25,870? That is the lowest point in the last couple weeks. Two hits, one here and one here. Okay, if we take that out, then you drop likely down just below 24,000. 24,000 is your short-term target. Now, let's be clear, I'm a trader. I would probably be covering my short right in this area. Okay, I might even flip it to a long for a quick trade. But a reminder out there, I'm telling you again what I likely will do, and number two is that I'm a short-term trader. So if I do decide to go long around 23,500, 23,007, then I would look for a bounce and I would exit. Because again, being a trader, you can be short-term bearish, but still take longs, and you could be long-term bullish and still take shorts. Like, it doesn't matter. You're trading the levels. You're trading probabilities. And by the way, the most freeing thing in the world is to trade inside of bigger cycles. So many people are like, oh, I'm only long or this or that. Okay, I'm okay with that. Again, especially for people that can't study charts, but there is a wealth of information that the charts give you that essentially can help you make money in bull markets, in bear markets, even when you're going counter trend, even going long in a bear market, even going short in a bull market. But over the next few years, it's likely going to be this kind of stinky, longer, drawn out, like, period, where you're in a recession and it just, because the Fed can't stimulate to get us out like we have been addicted, like drugs. The market and investors are addicted to the drugs of the Federal Reserve printing money. And if without them printing money, we're going to get stuck in this kind of mediocre recession that's going to last, in my opinion, for longer than the usual recession. Now, think about this, right? Does it make sense that we might be in a longer recession because the Fed artificially kept the bull market going since 2009, one of the longest bull market periods in history, if not the longest? Well, yeah, you know, if you stay up here too much or too long, it makes sense that you have to mitigate that on the average and have a down period for a certain amount of time. Gold and silver. Quickly, we're going to do gold and silver here. I know this is going on a little bit longer than the usual. That's okay. I still think gold, again, gold hits short-term support. That's fine. I still think there might be one more dip to about 1920, 1925. But again, at this point, I remain extremely mid to long-term bullish on gold. Gold is the pure play here. Bitcoin eventually will be. I know I'm a big bull on that long-term, but not on the short-term. Gold right now is the play, in my opinion. This is the pullback off triple top. We might go a little bit lower, but in this range, this is where you start to rock and roll.